First of all, me this opportunity to deliver this inaugural address at your 16th Mutual Fund Summit. We've heard fantastic observations from Sandeep, from Chirag, Sandeep Bagla, Gaurav, Sheila Kulkarni, and of course, Sundar. That was an amazing exposition. A lot of good insights and said in a very, very creative manner. I'm not going to be as creative. I'm going to be very, very boring. I'm here, as I mentioned, on behalf of my fellow whole-time member, Amarjeet Singh, the Executive Director, Manoj Kumar, and the excellent team of SEBI's Investment Management Department that oversees the mutual fund industry. I thought I would take this opportunity to offer some personal reflections on the very impressive journey of the mutual fund industry over the years, reflect on some of the risks that perhaps warrant attention from all the stakeholders, and refer to some of the exciting initiatives being undertaken by SEBI and the mutual fund ecosystem for the days ahead. First, the good news, and I understand this is largely the mutual fund industry, you truly need to take a bow. The mutual fund industry has made impressive strides over the last few years and is now playing a most crucial role in channeling financial savings towards risk capital formation. While stable macros, increased formalization, robust corporate earnings, digitization, and user-friendly access likely laid the foundation, the mutual fund ecosystem, for its part, has stepped up remarkably well to earn the trust and garner the savings of an increasing number of Indians. From less than 2 crore unique investors in mutual funds as of March 2019, the industry had grown to nearly 4.7 crore unique investors as of June 2024, an impressive compounded annual growth rate of 18% during that period. Since 2019 March, mutual funds have net garnered on average nearly 2.6 lakh crores each year from their investors. Of this, more than 2.2 lakh crores have been directed towards risk-oriented schemes, i.e. equity-oriented schemes, hybrid schemes, equity-oriented exchange-traded funds, and index funds. In comparison, the average FPI, the foreign portfolio investment inflow into equities, during the same time since March 2019 was just 61,000 crores per year, less than a third of the mutual fund inflow. This is a trend that we've been observing over the last few years, where domestic savings now dominates over external and foreign savings. The mutual fund flow momentum has only gathered further pace in the last 3 years. The average annual mutual fund flows into risk-oriented schemes over the last 3 years has risen to an impressive 3.3 lakh crores per year now, up from 2.6 lakh crores that I mentioned earlier. There can be little argument that these robust mutual fund flows, backed by strong earnings and stable macros, have contributed to the strong and steady performance of the Indian markets during this period. As an illustration, over the last 3 years, our benchmark indices, including Sensex of Sundar here, have given a creditable return of 14% compounded annual growth rate with an annualized realized volatility of just about 14.3%. Compared to other global markets, this represents higher return and lower volatility. As an example, during the same period, the Nasdaq Composite has given a lower return of just 3.7% compounded annual growth rate with a higher volatility of 23.5%. On the back of these robust inflows and market price growth, mutual fund AUM has grown from an INR 23.8 lakh crores as of March 2019 to 61.2 lakh crores as of June 2024, an impressive compounded annual growth rate of 20% per annum. The entire mutual fund ecosystem, from the AMCs, the distributors, the support partners, regulators, exchanges, media, analysts, and the investors, should collectively take a bow. Please give yourself a hand on this entire fantastic set of achievements. Now, as a regulator, I am paid to worry. And sometimes we are called wet blankets for always being worrying. You know, when there is so much of positivity around, why are you guys getting so worried? Now, I'm not good at Hindi, so please pardon me, but I learned this doha long ago. I think it's Rahim's doha. कि दुख में सुमिरन सब करे, सुख में करे न कोई, जो सुख में सुमिरन करे तो दुख काहे को होए. When things are looking good, maybe that's the time to reflect on what the risks are, so that we don't come to a situation where we have to go through a painful process. So, giving that, let me now worry a little bit about what are the risks that our ecosystem is facing. First of all, with all those good things that I've pointed out, which you all know very well, there is absolutely no room for any complacency. As Sundar also mentioned, there are plenty of opportunities to grasp, and at the same time, risks to recognize and manage. You know, besides all the statistics that Sundar mentioned, there are over 55 crore people who have their PAN numbers linked with Aadhaar. One could argue that they are all potential candidates to become part of the securities market ecosystem. However, our role as a composite securities market ecosystem is complicated. While growth in investor participation aids capital formation, we are also duty bound to ensure that the investments held by the mutual fund ecosystem in trust are managed responsibly, and that investors are both completely aware of and accepting of the inevitable risks that accompany securities market. You know, as whole-time member of SEBI, sometimes I get some very strange emails. Earlier this week, when we had, you know, our stock markets being a little volatile and coming off on the back of what happened with the yen carry trade and Nikkei falling and all of that, we received an email from an investor addressed to the chairperson and all the members, you know, saying what the hell is happening, why is it that our stock markets are falling just because Nikkei is falling. And he actually directed us, by end of the week, I want the markets to go back to all-time highs. Now, when we see messages like this, we get worried about whether people are adequately informed about the risks of investing in securities market ecosystem. These are exceptions, but nevertheless, sometimes the noise that we hear tells us that people have to be aware of. Too many people have only seen good times. Many people have not really seen market corrections as such. The first point that I want to, before that, the fiduciary responsibilities of the mutual fund industry should well outweigh any commercial goals and considerations. In this regard, here are some personal reflections on areas that warrant some study and debate. First, I want to talk about potentially a mismatch between the demand for paper and the supply of fresh paper coming into the ecosystem. I have spoken earlier at an earlier occasion about the need for some balance between the supply of fresh securities and the demand for fresh paper. Between FY17, fiscal year 17 and FY21, the demand for paper in secondary markets across mutual funds, domestic institutional investors, individuals and FPIs averaged about 23,000 crores per year. So for that particular period, that was the average. Since FY22, that number has risen by over 5 times to an average 1.26 lakh crores per year. Seen another way, let's look at another way. In FY24 alone, the fiscal year that just went by, the net demand for paper, both in primary as well as in secondary, from mutual funds, from domestic institutional investors, from individuals and FPIs, the core investors who bring in permanent capital into the country, stood at about 3.6 lakh crores. And this is both primary as well as secondary markets, that demand coming through. Against this, the supply of fresh paper, which means primary issuances, was less than 2 lakh crores. And I'm counting IPOs, FPOs, rights issues, QIPs, preferential issues, all of them. This mismatch has only grown in recent times. Of course, for every buyer, there has to be a seller. That's a given. There's no surprise there. But ideally, one would like to see as much fresh paper issued for the demand for paper, rather than substantially the same paper being churned to meet the demand for paper. So, fresh paper issuance is clearly a better reflection of capital formation and raises less doubts about asset price inflation. Sandeep spoke about valuations, and of course he eventually said valuations is not a worry. But you do hear periodically these questions of valuations coming up, and I think this mismatch contributes to that debate and that worry. Over the past 5 years, over 40% of all mid-cap, small-cap and micro-cap stocks have grown by over 5 times in price. While earnings growth, macros and any other number of factors can be used to explain price movements and justify prices, I would urge the experts in the industry, which you're all experts in the industry, as fiduciary managers of people's money, to collectively ponder over this. I also note that some large fund houses have proactively stopped lump sum investments in some small cap schemes and have also capped the amount that can be invested via SIPs into small cap schemes. So that is one set of worries that I reflect as a regulator, because that's my job to do so. A corollary to this, a bit about stress tests. As a result of the large inflows from individual investors into equity capital markets in recent times, the holdings of mutual funds, domestic institutional investors and individuals have inevitably risen as a percentage of free float in most companies. As an example, the holdings of mutual funds, domestic institutional investors and individuals have risen from about 54.3% of free float of all mid-cap and small-cap companies as of March 2020 to 60.6% as of March 2024. This does raise questions about what would happen in the hypothetical stress event of large redemptions from mutual funds, particularly from arguably less liquid mid-cap and small-cap schemes. To help address these questions, if you remember, mutual funds conducted their own stress tests of individual schemes and made the results public. While individual stress tests are useful to describe idiosyncratic risk of redemptions from one scheme or from one fund house, to capture system-wide risk, it is also important to model stress scenarios for the entire composite mutual fund ecosystem. SEBI's research team has done some preliminary analysis on this score. By considering how many days it would take for all equity mutual funds to cater to a hypothetical sudden and large 10% or 15% or 20% redemption over a short period of time, given current levels of average daily delivery volumes in the secondary markets. We are not for a minute suggesting this is going to happen. As I said, all this is hypotheticals, all this is sukh mein sumiran kar rahe hain. While SEBI's findings will be reviewed and published shortly, the preliminary findings are actually somewhat encouraging, with some caveats. The initial findings suggest that despite the substantial increase in mutual fund holdings of stocks over time, the number of days to cater to a hypothetical sudden 10 to 20% redemption have not really changed by much between, say, March 2020 and March 2024. There are, of course, caveats that need to be kept in mind. Secondary market turnover and average daily delivery volumes have increased substantially over the past few years. And this accounts for why the number of days to reduce mutual fund positions really haven't changed over time. A moot question could well be if secondary markets would be as welcoming of supply of paper by mutual funds during a stress period as they have been of demand for paper during the good times. An inevitable follow-on question would also be around the market impact in terms of prices of such a hypothetical event. In any case, I would strongly encourage the industry and AMFI to take the lead and proactively conduct objective and credible industry-wide stress tests themselves. Some people call stress tests a sign of paranoia. I've been an academic. So तुम academic हो, तुमको ये paranoia होता रहता है, you see ghosts under your bed. Actually, needless to add, stress tests of this kind are a core part of risk management for any financial sector ecosystem and help strengthen the ecosystem. As I said, these are prudential, done so that we can prepare for the bad times in the good times. Separately and more broadly, we perhaps need to explore better ways of conveying the risk of different mutual schemes better. While the existing riskometer is simple and a dramatic improvement over the earlier one, it perhaps does not adequately differentiate between the risks of many types of schemes that are on offer today. Many schemes are simply clubbed as high risk. It's not that all of them have the same type of risk. There are differentiations there as well. And that is something that we've got to try and work out. While ensuring simplicity and ease of understanding remains a key objective, perhaps the underlying volatility of the portfolio, along with the liquidity of the portfolio from the stress tests, could be used to provide better color all around. Again, given the crucial need to convey risks clearly to investors, as a former academic, I would strongly urge the industry to deliberate this issue more intently. Finally, a point about investor suitability and appropriateness and mutual fund distributions. Mutual fund distributors, or MFDs, have played a creditable and pivotal role in the impressive growth of mutual fund ecosystem over the years. As on date, there are over 1.6 lakh mutual fund distributors holding AMFI registration numbers or ARNs who have helped spread the good word far and wide across several PIN codes of the country. I am told that practically every PIN code in this country has been covered by the mutual fund distribution ecosystem. So kudos to you all. As you're aware, SEBI does not regulate mutual fund distributors directly. From our perspective, MFDs are a part and extension of the mutual fund industry. As such, mutual funds are responsible for the activities of the mutual fund distributors. Oversight here is crucial since ensuring client suitability and appropriateness, investor risk awareness and education, and guarding against any mis-selling is a critical part of ensuring sustained business growth and capital formation. Given that mutual fund distributors are paid by the producers, i.e. the mutual funds, and not by the investor, there is a special need to ensure that the investor's best interests are not just always protected, but are also seen to be protected. And we've unfortunately had some stray instances where we've seen this being compromised. In fact, AMFI has come out with a circular on July 24th to try and address some of those issues that we saw. But this is something that the industry again has to reflect on quite on an ongoing basis. So even while sterling work has been done by the ecosystem so far, I would suggest that there is a constant need to review and debate how investor best interests can always be protected. especially since we have a long way to go to increasing the investor base. Separately, you've also seen the recent steps announced by SEBI to try and expand the base of investment advisors in the country. Entities that are paid by the investor rather than by the industry, and therefore whose earnings are at least optically better aligned to the outcome of their investors. If you ask me, we need everything. We need investment advisors, we need distributors, they both have their utility, but both have to do both each other's jobs. Distributors cannot lose sight of customer interest, and vice versa for the advisors as well. I would like to end on a positive note, befitting an industry that has delivered remarkably over the past many years, and in many ways, an industry that is the flagship of our securities market ecosystem. Over the years, notwithstanding the robust discussions that sometimes we have as the regulator and the regulated, I think Sandeep alluded to that in a bit, the mutual fund industry and its members have increasingly become our trusted advisors and partners. Reflecting this trust and dialogue, there are several exciting initiatives on the anvil that have been co-created by all the stakeholders. The proposed introduction of mutual fund light regulations will offer light touch regulation for passively managed funds, reducing their compliance burden and fostering competition and innovation. The proposed introduction of a new class of schemes that run higher risk than the regular mutual fund schemes and are on offer to investors with somewhat higher risk capacity, understanding and acceptance is another exciting innovation on the anvil. Now think of the context. At a time when we are trying to discourage individual participation in high risk pockets, such as trading in index options closer to expiry, we are simultaneously trying to offer better avenues and vehicles for investors, including smaller investors, to assume higher risks in a better manner. Once again, this reflects our confidence that the mutual fund ecosystem are responsible partners in the journey to capital formation. The proposed low-ticket SIP and further sachetization and tokenization of regular SIPs is another exciting prospect for furthering financial inclusion while ensuring responsible investing. Some asks, as a regulator, I can't leave this place without demanding a few things. I suggest that the industry can do further work on streamlining operations and improving efficiency for our investors. At a time when instantaneous funds transfers have become ubiquitous in our country, perhaps we should look to improve our internal processes and the security settlement ecosystem to ensure that funds are passed on to investors on the day of the settlement itself, rather than a day after or 2 days after. Finally, as knowledgeable and respected ambassadors of the capital market ecosystem, we need the mutual fund stalwarts, including all parts of the mutual fund ecosystem, to remain trusted partners in both market development and in market regulation. With your eyes and ears to the ground, we look upon you to say something if you see something. You know, I often say this, some people have got bored of my saying this. SEBI is like the proverbial Bollywood police in the old movies, which comes in the last scene, jab sab kuch ho chuka hai, climax ho chuka hai, then they come and fire in the air. We find out the last. You guys are on the ground knowing exactly what is happening. Tell us. You know, it is your ecosystem as well. It's not SEBI. You know, supervision and maintaining credibility in the ecosystem is too important a job to be left to SEBI alone. It is our collective responsibility. So if you see something, please say something. Congratulations once again on the journey so far. And I have no doubt that you will continue to deliver on responsible financial inclusion into our securities market ecosystem, furthering the case of sustained capital formation. Once again, thank you to ASSOCHAM and thank you for your very patient hearing.